Welcome back to Talk Tickers. If you're listening to this, you're the type of investor who is hunting for the signal and is, frankly, tired of the noise. Today is Tuesday, January 27, 2026, and today we are clearing the decks.
We really are. It feels like a turning point for this name.
We are breaking down the Q4 2025 earnings for Enterprise Financial Services Corp, ticker EFSC. And look, I know what you're thinking.
Regional banking, yawn.
Exactly. Regional banking in this economy with everything going on with rates. You're probably picturing, free pens, checking accounts, maybe a toaster if you open a CD. But if you look at the data we have in front of us today, you are looking at the wrong map.
It is definitely not just a boring update. If you actually read through the transcript and the slide deck, which we have, so you don't have to, what you see is essentially a masterclass in what I call franchise proofing.
Franchise proofing. I like that. It sounds defensive, but also aggressive.
It's both. It's the best way to describe it. You have a management team that is aggressively compounding book value, which, let's be honest, is the only metric that really matters in the long run for a bank, while simultaneously handling a pretty massive cleanup operation.
Right, in their credit portfolio.
Exactly. They are fixing the roof while building a new wing on the house.
That is a great analogy, and we have a lot to get through. We've got a bottom line beat. We have this massive resolution happening with that headache of a real estate portfolio in Southern California that's been plaguing them for quarters.
There's real overhang on the stock.
And we have a management team that seems incredibly confident about the new year. Plus, I want everyone to stick around for the end
Of the not financial advice segment.
Exactly. We are going to pitch a trade based on the company's unexpected exposure to the AI power grid. It sounds crazy for a regional bank based in St. Louis, but the dots connect in a really interesting way. You do not want to miss that.
The data is there if you look for it. It's buried in the geography, but it's there.
But let's start with the headline numbers because the market is already reacting and we need to understand why. Give us the snapshot.
Okay, let's hit the scoreboard. GAAP EPS came in hot at $1.45. For context, the Street consensus, what all the analysts were expecting, was sitting at $1.33.
So a 12-cent beat. In the banking world, that's a substantial gap.
It's significant.
Okay.
Especially in this environment where every penny is being scrutinized for weakness. And on the top line, revenue hit $193.6 million, beating estimates by roughly $6.5 million.
Wow.
That's up 14.3% year over year.
And the market likes what it sees. I was looking at after-hours trading before we started, and the stock popped about, 1.48%, sitting around $55.92.
It did.
But let's play devil's advocate for a second. Is this just a less bad quarter than expected, or is it genuinely good? Because sometimes a beat is just about low expectations.
That's a fair question, but in this case, it feels like genuinely good performance. Management is calling this a demonstration of a relationship-oriented model. But the key takeaway, before we get into the weeds of the bad loans, is the core engine, specifically net interest income and margin. It is humming louder than expected.
All right, let's unpack that core engine, because for the long-term holders, this is the thesis. We hear so much doom and gloom about margins compressing across the banking sector. We hear that as rates drop, banks make less money. Why is EFSC defying gravity here?
It really is the standout metric of the entire report. Net interest margin, or NIM,
It actually expanded.
Expanded in this environment.
It came in at 4.26%, which is up 3 basis points from the prior quarter. Now, you have to pause and think about the broader context. We're in a world where almost every bank management team is terrified of falling margins as we stare down potential rate cuts in 2026. Right, because usually banks are asset sensitive. When rates drop, the yield on their loans drops faster than the cost of their deposits, and that margin gets squeezed. So how are they holding the line at 4.26?
It's the liability side of the balance sheet. They're actively managing their costs down. Deposit costs dropped to 1.64%. But the real secret sauce, and this is what you look for in a high-quality regional bank, is the mix.
The deposit mix.
A massive 33.4% of their deposits are non-interest bearing.
Hold on, that's over a third of their funding costing them absolutely nothing.
Zero. That's the moat. That is what protects their spread. When you have that much free funding, you can defend your margin even if the Fed starts cutting rates. It acts as a shock absorber.
Right. While other banks are scrambling to lower deposit rates to maintain a spread, EFSC just sits on this pile of zero-cost cash and lends it out.
And that's usually tied to operating accounts, right? This isn't grandma's savings account. This is a business keeping money in the bank to make payroll, pay vendors. It's sticky money.
Exactly. It's not hot money chasing yield, it's operational cash.
Hmm.
You don't move your payroll account just to get an extra 0.5% somewhere else. It's too much of a hassle.
Right. And speaking of cash and growth, we have to talk about the acquisition.
The big move. They closed the purchase of branches in Arizona and Kansas early in Q4, specifically October 10th. How did that play into these numbers? Because usually, when a bank buys something, you expect a messy quarter.
You do. You expect integration costs to blow up the efficiency ratio.
But that's not what happened.
That's the surprising part. Their efficiency ratio came in at 59.2%. The estimate was 60.2.
Wait, let's pause on that. So they integrated a massive acquisition, dealt with all the headaches of merging systems, and actually got more efficient than Wall Street expected.
That is rare execution.
Yeah.
Usually M&A is messy. Costs balloon, cultures clash, systems fail. This implies that the new assets aren't dragging down the ship. They're effectively tightening the sails immediately.
Management said this acquisition accelerated their strategy in high-growth Southwest markets by several years.
You don't often hear a CEO say they bought a time machine, but that's essentially what they did.
Oh, right.
They skipped years of organic building, hiring loan officers, renting office space, waiting for clients, and just bought the book of business.
And the numbers back it up.
Totally. It added $600 million in deposits immediately. And critically, management says it's fully integrated. It's already accretive to net interest income, contributing to that 168.2 million NII figure we saw.
Okay, so the engine is working. The acquisition is working. But we have to look under the hood at the messy stuff. This is a deep dive. We don't just read the press release and high five. There was noise in credit.
There was, and you can't ignore it.
Net charge-offs were elevated at $20.7 million. That's about 21 basis points for the year. For a bank that prides itself on credit quality, that number jumps off the page. What is going on there? Is the portfolio cracking?
This is the dirty laundry segment of the deep dive. And you have to deconstruct where that $20.7 million came from. It's not a broad-based deterioration. It's specific pockets. First, we have what I call the SoCal 7.
Sounds like a heist movie title. Or a really bad indie band.
It does, doesn't it? It refers to a specific relationship involving 7 properties in Southern California that the bank has been wrestling with.
Yeah.
We've talked about this before. This has been the dark cloud hanging over the stock.
But the narrative changed this quarter.
Drastically. The good news is we are seeing the end of the movie. They successfully foreclosed on 6 of those 7 properties in December. They moved them to OREO.
For the listener who isn't a bank analyst, can you clarify OREO? It sounds like a cookie, but I assume it's less delicious.
Much less delicious. Other real estate owned basically means the bank repossessed the property. They're now the landlord.
So they took it back.
Right. And usually OREO is a bad word because it means illiquid asset. It sits on the books and collects dust.
Right.
But in this case, it means control. They aren't waiting on the borrower anymore.
So they have the keys.
They have the keys. And they are currently negotiating purchase sale agreements, or PSAs, on 5 of those 6 right now. Management was very explicit about the timeline. They expect to have these largely resolved and sold by the end of Q2 2026.
So by summer, this headache should be gone.
That is the plan. And importantly, because they had already marked these down in previous quarters, taking reserves against them, moving them to OREO, actually resulted in a net gain in some areas due to fair value adjustments.
Oh, interesting.
It's a cleanup, not a new disaster.
Okay, so that's the real estate side. But there was another specific charge-off that caught my eye. They called it a last-mile blow-up, an $8.5 million hit on a single C&I loan.
Right. This wasn't real estate. This was business lending.
And this is where you have to be careful not to extrapolate too much. This was a fascinating little case study. It was a logistics company doing e-commerce packaging in Southern California. The classic story of a company growing itself to death.
How so?
Their revenue growth outstripped their capital structure. They expanded too fast, tried to capture too much market share, hit a liquidity wall, and collapsed. It's the downside of high-growth sector.
And EFSC was left holding the bag.
They were. But here is the key insight on this. This appears to be idiosyncratic.
Making a one-off.
Exactly. It's a bad loan, yes, and it hurts. But it doesn't signal that the entire C&I commercial and industrial portfolio is rotting. It's not a systemic issue with logistics. It's a specific issue with this management team at this company. And management explicitly said they wanted to clean the slate heading into 2026.
They took the pain now so they don't have to talk about it next year.
That makes sense. Kitchen sinking the quarter, as they say. Get all the bad news out while the earnings are strong enough to absorb it.
Precisely. If you strip out those two specific issues, the SoCal 7 and the logistics blow up, the rest of the portfolio looks fairly standard. They did mention a small contraction in sponsor finance, but that was mostly just private equity sponsors selling their portfolio companies. Just normalization.
So we have a strong engine. We're cleaning up the dirty laundry. Let's pivot to the future. What does 2026 look like? They gave us some guidance, and I want to know if it holds water.
They did, and it paints a picture of steady, controlled growth. For balance sheet growth, they're targeting 6 to 8%. For loans, they're looking at mid-single digits.
That feels conservative, doesn't it, given the acquisition, given the efficiency?
It feels very conservative. Management teams like to underpromise and overdeliver. But look at the NIM outlook. They are projecting a sticky 4.2%.
Wow.
And this is important. Their model assumes 3 Fed rate cuts in 2026.
3 cuts. So even if the Fed slashes rates 3 times, they think they can hold the margin at roughly 4.2.
That's the claim. And it goes back to that deposit mix we talked about. When a third of your money is free, rate cuts hurt you less than the competition. In fact, they might even help on the borrowing side.
Let's talk about capital allocation. This is how the shareholders actually get paid. They raise the dividend.
They did, to 33 cents per share, which is a signal of confidence. You don't raise the dividend if you think your loan book is about to implode.
Good point.
And they bought back 67,000 shares in Q4. But the metric they really want you to look at, and frankly, the metric we should be looking at, is tangible book value, or TBV.
The North Star.
It really is. It grew 11% year over year to $41.37 per share.
Why is that specific number so important? Why should I care about TBV?
Because if you look back, they have compounded TBV at greater than 11% for 14 years straight.
14 years.
Think about what has happened in the last 14 years. The great financial crisis fallout, the pandemic, 0% interest rates, inflation spikes, rapid rate hikes. Through all of that chaos, they grew the intrinsic value of the company by 11% a year.
That is the compounder narrative. It's boring, it's consistent, and it builds wealth. It's not the stock that doubles in a week, but it's the stock that doubles every 6 or 7 years without you stressing about it.
Essentially, yes, you're buying a machine.
Now, I want to touch on something CEO Jim Lally mentioned regarding client sentiment. Usually these calls are full of generic optimism, Clients are cautious but hopeful. But he got specific.
He did. He noted clients are optimistic, but he highlighted specific sectors. He said developers and contractors serving power generation, data centers, and infrastructure are expecting long runs of good business.
That is a very specific call out. Power generation and data centers.
It is, and it connects to the broader macro theme. We are seeing a massive build out of infrastructure, reshoring manufacturing, building the AI grid, and EFSC's clients are the ones pouring the concrete and wiring the grids.
Okay, hold that thought. We are going to come back to the data centers. But first, let's zoom out for the investor context. Why should the person listening right now care about EFSC versus a JP Morgan or a Wells Fargo?
Because this isn't a generic banking play. Regional banks are usually just a leverage play on rates. You buy them if you think rates are doing X. EFSC is positioning itself as a growth market play via that Southwest expansion.
So it works regardless of the Fed's next move.
That's the goal. And the catalyst is clarity. The main overhang on this stock was the credit uncertainty in SoCal. It was a penalty box stock.
Right. Investors were scared of those 7 buildings in California.
Exactly. I don't want to wake up to a massive loss.
And now?
With those assets moved to OREO and PSAs in hand, that market uncertainty should clear up by mid-year. Once the market stops worrying about the SoCal 7, they can go back to looking at that 11% compounding book value.
It effectively removes the discount.
Exactly. It clears the runway. You're buying a compounder that's currently priced like a distressed asset because of a problem that is 90% solved.
All right, that brings us to the part of the show where we take off the sensible banker ties and put on our hedge fund vests.
My favorite part.
It is time for This Is Not Financial Advice.
Disclaimer time. We are just 2 voices in your headphones. We are not your financial advisors. We are not telling you to do this. This is for entertainment purposes only. Do your own diligence.
Please, do not blame us if you lose money. Okay, I'm ready. Pitch me. What is the trade?
I call this the Southwest Power Grid ARB.
I love it already. What is the logic?
Okay, connect the dots we just laid out. Management dropped that breadcrumb about power generation and data centers seeing a massive
Like
boom.
long runs of good business.
Long runs, right? The AI energy crisis. We need more power for the chips. Everyone knows that trade. You buy NVIDIA, you buy utilities. It's a crowded trade.
Very crowded.
But everyone is already in those trades. NVIDIA is expensive. Utilities are slow and regulated. Now look at what this bank just did. They bought a massive footprint in Arizona and Kansas.
Oh, okay. Arizona and Kansas.
What are those states? Arizona is practically the capital of new data center build-outs because they have land and solar. Kansas is a huge energy corridor. These are the physical locations where the AI grid is being built.
So you aren't buying EFSC for the checking accounts.
No, you are buying it as a leveraged play on the AI energy crisis.
Walk me through the mechanics of the trade. How do we structure this?
The trade is go long EFSC and short a basket of coastal office REITs.
Whoa. Okay, explain the short first.
The short is the hedge against the old economy real estate that is suffering, the stuff EFSC is cleaning up in SoCal. You short the problem. You bet against empty office towers in San Francisco or New York. That protects you if the whole economy dumps.
Smart. But the long CAC, here is why you go long EFSC.
Management is guiding for mid-single-digit loan growth.
Which you said earlier felt like sandbagging.
I think it's a massive sandbag. As the power grid build-out accelerates in their new territories, Arizona specifically, their commercial and industrial book is going to explode with high-yield infrastructure loans.
These aren't small business loans.
No. This is heavy infrastructure financing for contractors building the grid.
So while the market is pricing EFSC as a boring regional bank dealing with some old real estate issues,
You are actually buying a utility infrastructure proxy. It's disguised as a regional bank, trading at roughly 1.3 times tangible book value. If that loan growth hits double digits because of the data center boom, that 4.20 margin is going to generate an enormous amount of cash.
that is wild. You're essentially betting that the bank's boring guidance is hiding a massive tailwind from the hottest sector in the world right now.
And that they bought the branches in Arizona right before the boom really took off. It's the perfect geographical arbitrage. They are the bank for the people building the AI grid.
The Southwest Power Grid ARB. I have to say it's compelling. It's speculative, but very compelling.
It's an asymmetric bet. Heads, you get a solid 11% compounder that pays a dividend. Tails, you get a massive growth surprise from the infrastructure boom.
Again, entertainment only, folks. Do not mortgage your house on our wild theories, but it certainly makes you look at that mid-single-digit growth guidance a little differently.
Just a little bit.
So let's wrap this up. What is the final word on EFSC Q4 2025?
Solid beat. Massive margin defense via those non-interest deposits. And the credit cleanup is nearly done. They are clearing the slate for 2026.
It really does feel like they are turning the page. The question for you, the listener, is this. Is the credit cleanup a red flag showing cracks in the foundation? Or is it a green light showing a management team that is proactive and ready to grow? What stands out to you?
Is it the SoCal 7 resolution, or is it that hidden AI play in Arizona?
Let us know what you think. We will be back with another deep dive soon. Talk Tickers signing off.
Talk Tickers signing off.